Hello everyone, this is Terry with Futures.io, and as always I would like to thank you for joining us today. Now it is my pleasure to welcome Richard L. Weissman from DTN IQ Feed for today's webinar, Finding Your Edge and Maximizing Returns. If you have a question, please feel free to type them into the questions box throughout the event, and we'll do our best to answer them at the end. If you're watching us on YouTube, please do us a favor and give us a thumbs up if you enjoyed the webinar. And as always, please feel free to share, comment, and subscribe to our channel. It really helps us a lot. For trading news, events, and information, follow us on Facebook, YouTube, and Twitter using @Futures.io. And now, without further delay, I'll hand it over to Dave from DTN for a quick little run through. All right, Dave, you should have the pop-up. All right, looking good. She's all yours. Dave, you may be muted. I can't hear you.
Okay, sorry about that. Yeah, thank you, Terry. Hi, this is Dave Force with DTN, and thank all of you for attending today's webinar, Finding Your Edge and Maximizing Returns with Unique Technical Indicators, which will be presented in just a minute by Richard L. Weissman. But first, we want to thank Big Mike and Futures.io and mention that Futures.io, the best futures trading community on the planet with over 100,000 members, many of which are IQ Feed users. In fact, if you're not using IQ Feed now, you should be, because nobody has faster, cleaner, more complete, and more reliable market data than IQ Feed. Many Futures.io members are currently using real-time, unfiltered, true tick-by-tick IQ Feed futures data, stock, and other market data in their NinjaTrader software, Sierra Charts, or one of the other 80+ popular charting and technical analysis software programs. In addition to our real-time streaming data, we will soon have available the ability to download the whole market on an end-of-day or intraday basis. And as always, we still have the Futures.io half price special. But in order to receive the Futures.io half price deal, you will want to make sure that you use this special Futures.io link when signing up for the IQ Feed free trial. Then after your trial period, be sure to contact me if you want the Futures.io half price subscription. We'll have this link available again at the end of the webinar. Now I'd like to introduce Richard Weissman. Richard will be talking about finding your edge and maximizing returns with unique technical indicators by analyzing the crude oil markets. Richard is an instructor with DTN of trading and management courses, co-sponsored by CME Group and ICE Exchange. Richard has over 20 years of experience consulting and teaching traders and risk managers, including most major oil companies. He is the author of Trade Like a Casino, Find Your Edge, Manage Risk, and Win Like the House, which was a Technical Analyst Book of the Year finalist in 2012. With over 30 years as a professional trader, here is Richard Weissman. Richard?
Thanks, Dave.
All right, Richard, you should get the pop-up to share your screen again.
Yep.
All right, there we go, looking good, and she's all yours.
Great. Thanks so much. So I wanted to take this time to introduce you to technical indicators that can be brought together in order to develop positive expectancy models that are applicable to the energy markets and specifically the crude market. Okay, so I'm going to reference something throughout this webinar called the casino paradigm. And there's a story behind it, and it relates to the title of my second book. So when I finished my second book, John Wiley, my publisher, said, what are you calling it? And I said, I'm still thinking about what the title should be. And they said, well, we've come up with a title, and it's called Trade Like a Casino. And I said, that sounds great, because first of all, I didn't have a title. And second of all, more importantly, the book is divided into 3 parts. And the title of part 1 is The Casino Paradigm. So when I entered in the business in '87 as a local on the floor, I started the way most small traders that are speculators start, which is by losing. And it didn't take too long before I noticed that there was this group of traders off on the side with gray hair, and they seemed to be winning. Not necessarily every day, but in general, they were making money. And it didn't take too long after that until I walked over to them humbly and asked, what am I doing wrong that you guys are doing right? Except I said it in a kind of analytical way. I said, what is this industry like? How can I model my behavior so that I can enjoy profits? What is the business of speculative trading like? Either they knew what the answer was but didn't want to say because people think that trading is nothing more than glorified gambling, or they didn't know what the answer was. But it is like the gaming industry. A player walks into a casino. Is it possible that that player could walk out of the casino 4 hours later with more money than they walked in with? Of course, otherwise no one ever walks into a casino. That being the case, why aren't the casinos shaking in their boots at that possibility? Because no matter what game you play, as long as it's in their casino, probability is skewed against you, the player, and skewed in their favor, the casino. And in the gaming industry, they call that the probability skew. And in trading, we call that a positive expectancy model. And what that means is, even after deducting for costs, in other words, commissions that are going to the broker and the spread between the bid and the ask, or what we call liquidity risk, the model still generates profits over the long run. But even in the gaming industry, probability skew is not enough. Let's say Bill Gates walks into the same casino and he's got a cashier's check for $1 billion and he says, turn it into chips. And they will. When he takes the wheelbarrow full of chips over to the roulette wheel and says, put it all on red, are they going to take that bet? In fact, they won't. Why not? Don't they have probability skewed in their favor? In fact, they do. But they know if they let the player bet too big on a single spin, and the outcome is the low probability outcome because you've let the player bet too big. Now the player owns the casino. Bad business model. So they instill what are known as table limits. They say, hey, Mr. Gates, we're happy you want to play here, but you can't risk more than $5,000 per spin of the roulette wheel. By forcing the player to bet smaller, it ensures that if they play long enough, the probability skew will swallow up the entire $1 billion. And that's why there's no clocks in a casino. And that's why there's table limits, more importantly. Now, in the world of speculative trading, we call table limits risk management. And I didn't come up with the 1% rule. The first time I ever saw it anywhere in a piece of trading literature was in Market Wizard's Jack Schwager's book, The Interview with Larry Hite. He talks about the 1% rule. It's a pretty simple rule. It basically says never risk more than 1% of assets under management on any particular trading idea. So if your idea is crude oil is going up and you have 100,000 in an account, you shouldn't risk more than $1,000 on that idea. So that's risk management, and that's the table limits in the gaming industry. And interestingly enough, in the world of the casino, that's all you need. In the world of trading, that's all you need as well. It's just that people don't believe that that's all you need. So in the book, I came up with the analogy of the opaque urn. So there's this urn, it's opaque, you can't see what's inside of it, but I'm telling you what's inside of it. Inside of the urn is 57 green balls and 43 red balls. Bet on a color, and we all say green. Out pops the first red ball. Now there's only 42. Bet on a color, green. Out pops the second red ball. Now there's only 41. Bet on a color, and the third red ball pops out after we bet on green. What behavioral psychologists have found is that most normal human beings after this experience have said, this game is not for me, and they go on and become productive members of our society. The rare disturbed individual now decides that I've been lying to them the whole time about the green and the red balls, and they start betting on the red balls, and then the green ones come out. So it's not that there's no such thing as a positive expectancy model. My first book, as well as the second book, they're filled with positive expectancy models, and I'm going to go into some positive expectancy models in this presentation. It's not that there aren't people who know how to manage the risk, although I will freely acknowledge this is where most people fall down. It's that very, very few people that employ a positive expectancy model and sound rules of risk management can keep betting on the positive expectancy model and keep managing the risk when the losses come in clusters. So in the old days when I used to do private consulting, I had one old floor trader that was working with me. After around 6 months, he said to me, when is this ever going to get any easier? And I said to him, this is never going to get any easier. It's always going to be difficult, and that's why very few people make money at it. And that's the way we like it. If it was easy, then everyone could be doing it, and there wouldn't be any money in it. So that's the good news and the bad news. The good news is the casino paradigm is a real thing. The bad news is it's difficult. I've been doing this over 30 years, and it's still difficult, even for me. I've never yet met someone who said, oh, this is so easy, to the world of speculative trading. And that's why it works. So it's a good news, bad news thing. But that's what this business is. That's why you're interested in this material. That's why you're watching the webinar. Okay, so let's talk about finding your edge, finding a positive expectancy model in the oil markets, in today's oil markets. So we're going to be using ProfitX software in order to identify setups that are what I like to call, for lack of a better term, the golden ticket. What is the golden ticket? It's low risk setups that offer high reward and have high probability of success. Okay, so I'm going to give you two different examples. Those examples are low volatility breakouts and pullbacks within long-term trends. So, and I'm going to use mathematically derived formulas for technical analysis for charts. So there's no like, oh, are we above the trend line? Or are we below the trend line? How did you draw that trend line? It's all based on math. So as long as we're all using the same data, you know, let's say the November WTI Cushing, Oklahoma, November 2018 CME Group futures contract, there shouldn't be any debate as to whether we're above the 200-day simple moving average or below. Okay, now why am I giving you these two examples? So there's reasons behind it, and those reasons are outlined in detail in the courses that I present for DTN. These are 2-day courses on technical analysis. So I'm just giving you a little taste of what this material is, but certainly something is better than nothing. And also they're outlined in my book, Trade Like a Casino. All right, so let's talk about the first one, a breakout from low volatility. So volatility cycles. It cycles from high volatility to low volatility over and over again. So what do we know about low volatility? We know that as long as the asset still trades, it's going to have to cycle out of low volatility and into high volatility. Why? Because if you think about it, low volatility is an extremely unstable state. It's a state of market consensus. Everyone agrees that fair value for WTI November futures is, I'm just making this up now, $70 a barrel. Okay? And there's consensus. So we can't really get much above 71 because fair value is 70, and we can't get much below 69 because fair value is 70. That consensus is highly unstable. That low volatility is highly unstable. What do I mean? I mean, anything can knock it out of that stable, very narrow channel of market action. A surprise out of Saudi Arabia, a surprise out of Russia, increase in supply out of the US, out of North America. Anything, it's so unstable that anything can knock you out of low volatility. Okay, so the longer, here's the thing, we'll never know, a low volatility environment, we'll never know ahead of time whether we're gonna break out to the upside or whether we're gonna break out to the downside. The only thing that we know is the longer we are flatlining like that, the greater the probability of a breakout. So high probability, right? That's why it's a high probability setup. Okay, now two things can happen when we break out from low volatility. One is a false breakout. In other words, let's say the high was 71, the low is 69, and we break out and we buy on a stop 71.03 because it looks like it broke to the upside. Two possibilities. A false breakout. Well, if it's a false breakout, it's a false breakout within the context of low volatility, and we're going to come right back into the range, and we're not going to lose more than $2. The other so high probability, because the longer we flatline, the greater the probability of a breakout, and low risk, because we were in a low volatility environment. So if it's a false breakout, it's going to be low risk. The other possibility, of course, is a real breakout. And because we were in low volatility, because we were in a low risk environment, the possibility of a breakout from low volatility enables us to have high reward. So that's a golden ticket scenario. Low risk, high reward, high probability. All right, let me do one more with you. Pullbacks within long-term trends, within the context of a long-term trend. Okay, so think of it this way. It might actually be that we started a new bear market in the S&P. It might actually be that we've started a new bear market in crude oil. But if we haven't, and this pullback in crude oil is nothing more than a pullback in the context of a longer-term bull market, then by buying into that pullback, there's two possibilities. If you wait for the pullback, there's two possibilities. A reversal of trend, in which case you waited for the pullback, so it's low risk. The other possibility, of course, is a reassertion of the dominant long-term bull market trend. Because you waited for a pullback, high reward. High probability because trends don't change every week. Long-term trends, as defined by the 200-day simple moving average on a daily chart, they don't change every week. They don't even change every month. So there's a high probability when you have a pullback in the context of that long-term trend, in this case, bull market in crude, there's a high probability of the reassertion of the trend. If the trend does reassert because we bought into a pullback, high reward. And if the trend reverses because we bought into the pullback, low risk. So that's two examples of the golden ticket. And now that I've kind of given you the 3,000-foot overview I'm going to go into some details. Okay, and just so you guys know, the reason why I'm pausing like that, we have to make sure that everyone's hearing the audio. It takes a couple seconds delay. So first things first, let's talk about exploiting breakouts from the low volatility environment. So this is a concept, and that's how I build all my models. I build them on simple concepts. What do we believe about market behavior? We believe in the cyclical nature of volatility, that low volatility will resolve itself in high volatility and vice versa. And the second concept, obviously, I've alluded to as well, which is we believe in the trending nature of markets, that a bull market is likely to continue much longer than people anticipate. A bear market is likely to continue much longer than people anticipate. Okay, let's talk about exploiting this concept of breakouts from low vol. So how are we going to define low volatility first of all? Well, there's many ways to do it, but what I'm going to do is I'm going to use a daily chart, and I'm going to define low volatility as an ADX reading of less than 20, and this is for a 10-period ADX. And we're looking at daily charts. So a 10-day ADX reading of less than 20 from 2 bars ago. And I'll explain why 2 bars ago. Why 2 bars ago? Because 1 bar ago, the prior bar, we broke out according to a print above, beyond, in other words, a print above the upper band, Bollinger Bands. So Bollinger Bands. 2 standard deviations above and 2 standard deviations below a 20-period simple moving average. So in the prior bar, we printed above the upper band. That's a bullish breakout. In the prior bar, we printed below the lower band. That's a bearish breakout. So why is ADX 2 bars prior in low vol? Because the bar prior was the breakout bar. So we want to know, prior to the breakout bar, were we in low volatility? Okay, so what's this whole thing about offset 1, offset 2? It's just the basic way that all this model building works is we don't know if we printed beyond today's bar, the upper Bollinger Band, or printed beyond the lower Bollinger Band until it's yesterday, right? Today, we don't know whether it's going to happen. We always want to wait for the trading day to end. And especially if we're not just looking for a print beyond, but a close above or a close below. And I kept it with print beyond on your slide here so that I could show you, this is just one way of creating the definition of a breakout. The more common way would be a close above or a close below. And especially if we're going to use a close above the upper band or a close below the lower band as a definition of the breakout, then we need to absolutely use yesterday's close, because we don't know today's close until today becomes yesterday. I'm going to employ a methodology for the trailing stops, the stop losses, that's going to get us out of this trade once we're in, once we have the definition of a breakout, once we've broken out, based upon a concept in Trade Like a Casino called minimizing trader regret, or regret minimization. So it's a pretty simple concept. We're going to take off half the position at the prior days. So let's say we have a bullish breakout. We break above the upper band. We're going to take away half the position, take off half the position based upon a trailing stop, which is yesterday's low of the day. Okay, so it's going to move from, once we have a new day, it's going to be the prior day's low of day, prior day's low of day, until eventually we break the prior day's low of day and you're stopped out of 50%. The remaining 50% will be set at the opposing outer Bollinger Band. So it's going to move as the trend hopefully matures. Okay, I don't want to take too much time on the mechanics of what is ADX. I just have it in your notes here for reference. I want to spend more time on the mechanics of how this thing works, functionality, things like that. But I'll go over it very briefly here. So Wells Wilder was the developer of something called Directional Movement Index. It's a system providing trading signals and can be used for breakouts from a trading range, which is what we're interested in. It involves 5 indicators, the directional movement index, plus directional indicator, minus directional indicator, and the average directional movement, which is what we're interested in, ADX, and then something else called directional movement rating, ADXR. So it's plus DI and negative DI, which are the building blocks for all the fancy stuff. And what we're interested in particularly is ADX. So this is a measure of volatility. And rising ADX is readings above 20, indicating trending action. And what we're specifically interested in, if you remember the prior slide, is readings below 20, range-bound action, right? The longer we're in low vol, the longer we're range-bound, the greater the probability we're going to break out and start trending. Okay, so again, DMI is the net directional movement equal to the largest part of the day's range that is outside the prior day's range. So if you have an inside day where you don't break the prior day's high or low, you're going to have a DMI of 0. The outside day, it's going to be the greater of the net high or the net low. Then we're going to take a weighted moving average of positive movement and divide it by a weighted moving average of each day's true range to get plus DI, a weighted moving average of negative movement, divided by a weighted moving average of each day's true range to get negative DI. So look at my note. Don't let the plus and minus signs confuse you. They indicate upward or downward movement, not values. Directional movement value is always a positive number or absolute value, regardless of upward or downward movement. Okay, and here's the formula. So DI diff is the absolute value of product of plus DI minus minus DI. DI sum is product of plus DI plus minus DI. And we get DX from these building blocks, and that is the product of DI diff divided by DI sum times 100. So now you have a number mathematically, if you think about it, that is always positive and always bounded between, you know, it can never go below 0 and it can never go above 100. Then ADX, the one we're interested in, is a 9-period smoothing of DX. That's why the readings below 20 are showing us low volatility, if you think about it mathematically. So what are we interested in here? Again, if you remember, we're looking at this area. Readings below 20, low volatility. Look at it on the chart. So this area in March, low volatility. right? Sideways action, resolving itself in trending action. That's it. That's an example. Okay. Okay, this is just a review of Bollinger Bands. I already went through it, but here it is again. 2 standard deviations above and below a 20-period simple moving average. And this is an example of it. You can see in 12/12 that week, the week of 12/12 to 12/17, you see a big violent down bar, and it moves the whole moving average down. So yes, the upper band rises, but its rise is less dramatic than the fall of the lower band because the whole moving average has moved due to the dramatic move in the asset and its impact on the moving average. So, so here again, we have the low volatility breakout system. Low volatility is defined as ADX from 2 days prior, giving us a reading below 20. And remember, it's a 10-day ADX. And then a print beyond the outer band, offset 1, yesterday's outer band is defining the breakout. And then we'll use the regret minimization trailing stop losses, 50% at the low of day, high of day, and the 50% at the opposing outer bands. And here you can see an example. So we have a low volatility reading. We have a breakout above, and we end up buying the market. Next open. And we're going to get stopped out of 50% very, very quickly as soon as it takes out the prior day's low. So that books, you know, not much, around $1.50 in profits, but immediately. And that gives us the courage to withstand the drawdown that's occurring in the week of April 2nd. And then finally, we get more trend following action all throughout the month of April and throughout the early part of May. And finally, we do get the correction that takes us to the lower band and stops us out of the remainder of the position for a profit of $4 and change, let's say. So that's how we're turning these indicators, ADX and Bollinger Bands, into a complete trading system with rules of risk management and exit, as well as rules of entry. Okay. Okay, let's look at our second concept. Taking advantage of pullbacks within the context of a longer term trend. So the longer term trend is going to be defined as yesterday's close in relationship to the 200-day simple moving average. So we're going to define a bull market as yesterday's close was greater than yesterday's 200-day moving average, and a bear market is yesterday's close is less than yesterday's 200-day moving average. And then we're going to define a pullback as a 9-day RSI reading greater than yesterday's RSI reading, greater than 70 or less than 30. Okay, so this is just a brief explanation of relative strength index, RSI. It was another Wells-Wilder indicator developed in the 70s. It's bounded. It can never go below 0. It can never go above 70. So the closer you get to 0, the more oversold you are. The closer you get to 100, the more overbought you are. And that's what I'm showing you here. Movements above 70, overbought, below 30, oversold. When you're in a strong trend, you can see readings of 80 or 20. Usually the first move into overbought, oversold is not a trend change, it's just a warning. And this is our formula. RSI is the product of 100 minus 100 divided by the product of 1 plus RS, where RS is the average of, let's say, 9-day up closes divided by the average of 9-day down closes. And what we're going to use for overbought, oversold is 70 and 30. Then we're going to overlay moving averages. So it's an indicator that objectively, according to mathematical calculations, enables us to define the trend. So our definition of the trend is going to be above the 200-day moving average, bull market. Below the 200-day moving average, bear market. And then let's turn these indicators, RSI and the simple moving average, into a complete trading system. So we're going to do that with these rules. So we're going to define long entry, entering a trade on the long side, as when yesterday's close is greater than yesterday's 200-day moving average, so that we are buying into a bull market as defined by the 200-day moving average. And second criteria, RSI, the 9-period RSI is oversold, meaning that we have a reading below 30. Long exit will occur whenever the 9-day RSI has an overbought reading greater than 70, or OCA means one cancels all, one cancels the other, or the whole trend changes when we have a close that is less than the 200-day simple moving average. Either one of those two criteria gets us out. And then I'm going to do something that's going to save you a lot of time when you're explaining this stuff amongst yourselves to fellow traders. Short entry, short exit, same thing, opposite sides, right? So close is less than 200-day moving average, and RSI is a reading of greater than 70. And then exit is whenever the RSI gets oversold, in other words, a reading below 30, or you have a close which is greater than the moving average. And here's an example. So as you could see, the week of mid-February, we've got RSI giving us the oversold reading, and notice that we're still closing above the 200-day simple moving average. That's your buy signal at 57.45, the next day's open. And then we have the reading in the tail end of April, where we have a reading in RSI above 70, so that gets us out with a profit. Notice we never had a close below the moving average, so we never got stopped out with a loss. Trend following, right? Okay, so we are going to now turn it over and open it up for questions.
Hi guys, if you have questions, please feel free to start typing them into the questions box, and I will ask them to Richard. There's one question. Why not use OVX to measure oil volatility?
So you can. I was just giving you one way of doing it. There's lots of different ways of doing it. So you can do stuff like that. I'm just showing you one way. You can use average true range. You can use Bollinger Band difference, the difference between the upper and lower bounds. Many ways of doing it. I was just showing you ADX.
Right.
So there is a reason in programming specifically. So if you go outside of the world of crude, now there is no OEX. So now what are you going to use if you want to understand whether coffee is in low volatility or corn is in low volatility?
Okay. What time frame does this imply? This seems like a longer term trading strategy, not an intraday trading.
So obviously, both of these are going to take advantage of trending action. So the idea is you want to be in longer in order to make more money. I do have a different set of strategies that I use for short-term trading, and we go over that in my technical analysis class. That's a 2-day class. This is like, you know, an hour-and-a-half presentation.
Okay. How would you adapt the low volatility breakout strategy for highly volatile instruments like cryptocurrency? Obviously, a 90-day average is almost useless for something that volatile. Will it work with shorter time frames? I guess that kind of ties in the same question.
So yeah, when you're dealing with shorter time frames, I have a whole other set of tools that I'm using, and it's really kind of beyond the scope of what we're doing here. But certainly, I'd be more than happy to work with Terry and Dave and do one on short-term trading. I've got the material. It's part of my course. Happy to do it for you guys.
Okay, we'll look into that. Do you backtest, and what is the profit factor, max drawdown, equity curve, etc.?
Okay, so this is gonna, so yes, I do. And this is gonna change based upon the asset that you're dealing with. So I don't have the numbers for crude oil off the top of my head. But generally speaking, you know, the profit to max drawdowns on these things are pretty decent. They're in, you know, it depends on how big the look back period is. If you're doing a 10-year look back over a broad array of commodities, you're generally speaking something in the neighborhood of, you know, somewhere between 2 and 3 profit to maximum drawdown ratios.
Okay. There's a question on where do we find out info on the 2-day class. I told them to email you, Richard, via the address on this slide.
Okay.
I'm assuming that would be acceptable.
That's fine. Yeah, I mean, I'm not in sales. I just teach the courses, but I will certainly get them, you know, forward them on to the head of education sales at DTN.
Okay. All right, give them another minute or so for another question or two. All right, I think that's it for the questions. Thank you for the webinar today, for the information, and for spending some time with us this evening.
Thank you, Terry.
Thanks, Richard. Thanks, Terry.